Most people think 2026 is just another year for investing. It isn't. The strategies that worked in 2010, 2015, even 2021 are quietly becoming financial liabilities. And the worst part? Most investors won't realize it until the damage is already locked in. There's a dangerous assumption spreading among everyday investors in the United States right now, that the market of 2026 will reward patience the same way the last decade did. That assumption is wrong. The 2010s trained investors to believe that time alone fixes bad decisions. Buy broad indexes, ignore risk, hold forever. That mindset worked because interest rates were near zero, liquidity was endless, and central banks protected asset prices. That era is ending. By 2026, we're operating in a structurally different investment environment. Higher for longer interest rates, persistent inflation pressure, massive government debt refinancing, and aging demographics forcing capital rotation, not expansion. Here's the uncomfortable truth most channels avoid saying clearly. 2026 will not reward passive investors equally. Some portfolios will quietly compound. Others will slowly bleed purchasing power, even if prices look stable. And the scary part? Both portfolios may look fine on the surface. Let's talk about why. In past cycles, risk was obvious. Crashes were loud. Panic was visible. But the 2026 risk is different. It's silent erosion. Inflation doesn't need to spike dramatically to hurt you. A steady 3 to 4% inflation rate over several years quietly destroys long-term fixed income returns, savings accounts, and poorly structured retirement portfolios. At the same time, equity markets face valuation compression. Not crashes necessarily, but lower forward returns. That means the biggest enemy for 2026 investors is not volatility, it's false comfort. And false comfort is how retirement plans fail without triggering alarms. Another shift investors underestimate is policy risk. The U.S. government must refinance trillions in debt over the next few years. That reality influences bond yields, tax policy, market liquidity, and even which asset classes get quietly supported or sacrificed. Smart money sees this already. That's why institutional portfolios are being rebuilt around cash flow resilience, inflation-adjusted returns, assets that benefit from capital rotation, not speculation. Retail investors, meanwhile, are still chasing past winners. And that gap is where wealth transfer happens. So before talking about stocks, crypto, real estate, or dividends, there's one rule you must accept for 2026. This is not a buy-and-forget decade. It's a decade of positioning. The investment plan that works in 2026 is not aggressive, it's not flashy, and it's definitely not emotional. It's structured, defensive where needed, opportunistic where justified, and built to survive policy shifts, not just market headlines. In the next, I'll break down the core framework that every serious 2026 investment plan must follow before thinking about real estate.
There's
Because
one
if the
mistake
structure
that
is
destroys
wrong,
more
no
portfolios
asset
than
allocation
bad
will
picks
save you.
ever will.
Before
Most
picking
investors
what to
build
invest
portfolios
in,
by
you must
assets.
understand
Smart
how
money
your
builds
portfolio should
portfolios by
behave
behavior.
in a 2026
If you want your
environment.
investment plan to
That's where
survive
most
2026,
investors fail.
you must stop asking, what should I buy? And start asking, how should my portfolio behave when conditions change? That question changes everything. The biggest failure of retail investors is building portfolios that only work in one environment, usually the environment they're most comfortable with. But 2026 is not a single environment year, it's a transition period. And transition periods punish rigid portfolios. The first principle of a strong 2026 investment plan is role-based allocation. Every dollar in your portfolio must have a job, not a hope, not a prediction, a job. Smart portfolios in 2026 are typically divided into 3 behavioral layers. Layer 1 is stability capital. This is money designed to protect your financial nervous system. Its job is not to beat the market. Its job is to prevent forced selling during volatility. This includes high-quality, short-duration bonds, treasury ladders, strategic cash reserves. In a higher-rate world, stability finally pays something again. Ignoring this layer forces emotional decisions later, and emotional decisions are the real cost of bad planning. Layer 2 is income and inflation defense. This layer exists because inflation is no longer temporary noise, it's structural. Assets here are chosen for their ability to generate real cash flow, not hype-driven appreciation. Examples include dividend growth equities, real assets with pricing power, select infrastructure and energy exposure. This layer helps offset rising living costs without forcing principal liquidation. Most retirees and near retirees underestimate how dangerous inflation is to fixed income streams. That mistake becomes obvious too late. And once income falls behind inflation, recovery becomes mathematically harder. Layer 3 is asymmetric growth. This is where opportunity lives, but under strict control. This layer is not about betting the portfolio. It's about positioning for upside without risking survival. This is where selective equities, innovation exposure, and limited alternative assets belong. Crypto, for example, only fits here when sized responsibly, not as a belief system, but as a calculated asymmetry. Smart money doesn't ask, what if it goes to zero? They ask, what if it works, and how little do I need exposed for that outcome to matter? That mindset alone separates professionals from gamblers. Now, here's the most important rule. These layers must rebalance automatically, not emotionally, not based on headlines, based on predefined rules. When growth runs ahead, profits feed stability. When volatility hits, stability funds opportunity. This is how wealth compounds quietly. The average investor does the opposite. They chase performance late and panic early. By 2026, that behavior gap widens because markets won't crash dramatically enough to scare everyone out. They'll grind just enough to exhaust the undisciplined. In the next, I'll break down exact asset categories that fit inside each layer and which popular investments fail this framework entirely. Because not everything that sounds safe actually is. Before picking what to invest in, you must understand how your portfolio should behave in 2026. That's where most investors fail.
By 2026, some investments will look safe, sound responsible, and still quietly damage long-term wealth. Because safety in the past is not safety in the future. Now that the structure is clear, we can talk about assets, but not in the usual way. Because the biggest mistake investors make is assuming that popular equals resilient. It doesn't. Let's start with assets that actually fit a serious 2026 investment plan. First, short-duration, high-quality bonds. For years, bonds were dismissed as useless, but higher yields changed their role entirely. Short-duration treasuries and investment-grade bonds now provide real income, lower interest rate risk, stability during equity drawdowns. Long-duration bonds, however, are still vulnerable. They look safe. They're not. Duration risk is the silent killer most portfolios ignore. Second, dividend growth equities. Not high-yield traps, not companies borrowing to pay dividends. We're talking about businesses with pricing power, strong balance sheets, a history of increasing dividends through multiple cycles. In 2026, cash flow matters more than stories. Companies that can raise prices without losing customers survive inflation. That's where real equity safety comes from. And no index fund screens for that properly. Third, selective real assets. This does not mean over-leveraged real estate speculation. It means exposure to real-world demand, energy infrastructure, utilities with regulated pricing, materials linked to long-term capital spending. These assets don't explode upward, they endure, and endurance compounds. Now let's talk about assets that quietly fail 2026 portfolios. The first is long-term fixed income locked at low real yields. This includes older bonds and annuities purchased without inflation protection. They don't crash, they decay, and decay is harder to notice than loss.
By the time it's visible, it's irreversible. The second risk is overconcentration in broad equity indexes. Index investing worked brilliantly in a falling rate world, but in a flat to higher rate environment, indexes become valuation-weighted risk pools. Overvalued companies dominate returns and losses. This doesn't mean abandoning indexes entirely, it means understanding their limits. Third, speculative growth without cash flow. This includes unprofitable tech, hype-driven crypto exposure, and narrative trades. These assets are not investments in 2026. They're volatility devices. They belong only in the asymmetric growth layer and only in sizes that won't harm the portfolio if they fail. Smart money doesn't remove risk, they cage it. Finally, let's address real estate. Real estate is no longer a guaranteed inflation hedge. Rising financing costs, taxes, and maintenance compress returns. Only well-capitalized, cash flow positive properties survive this cycle. Leverage without margin of safety becomes dangerous fast. So here's the truth most investors resist. 2026 is not about finding the best asset. It's about eliminating hidden fragility. Assets that rely on cheap money, blind optimism, or constant appreciation fail first. Assets that generate income, control risk, and adapt survive. In the next part, we'll talk about timing and positioning, when to move, when to wait, and how to avoid the most expensive mistake of all, acting too early or too late. Knowing what to own is only half the equation. Knowing when to adjust is where most wealth is lost or preserved.
Most investors don't lose money because they chose the wrong assets. They lose money because they entered at the wrong time with the wrong expectations. And 2026 will punish that mistake brutally.
Timing doesn't mean predicting tops and bottoms. That myth ruins more portfolios than market crashes. Timing in a serious investment plan means positioning capital gradually, based on conditions, not emotions. This is where retail investors fall apart. They wait too long, then rush in all at once, or they panic early and miss the recovery. 2026 is not a year for dramatic all-in moves. It's a year for sequencing. And sequencing decides who compounds and who stagnates. The first rule of 2026 positioning is capital pacing. Instead of deploying money in one decision, smart investors divide capital into tranches. Why? Because markets in transition don't move cleanly. They chop. They exhaust patience. Deploying in stages reduces regret, improves average cost, prevents emotional paralysis. This applies to stocks, bonds, and even alternative assets. If you feel pressure to act now or miss out, that's usually a signal to slow down. Urgency is rarely your friend in investing. The second rule is expectation management. The biggest hidden risk of 2026 is assuming returns will look like the 2010s. They won't. Lower growth, higher rates, and tighter liquidity mean returns will be more uneven, more strategy-dependent, and more patience-driven. Investors who expect smooth gains will overtrade. Overtrading destroys returns quietly through bad timing and friction. Smart money expects boredom and plans for it.
Boredom is often a sign the strategy is working. The third rule is reaction discipline. News cycles in 2026 will be aggressive. Every policy decision, election headline, and inflation print will be framed as urgent. Most of it won't matter. Portfolios fail when investors react to noise instead of structure. That's why predefined rules matter. When to rebalance, when to add, when to do nothing. Doing nothing is a strategy. if it's intentional. Retail investors mistake activity for intelligence. Professionals don't.
The market pays patience, not effort. Finally, let's talk about the most expensive mistake of all or nothing thinking. Either fully invested or completely defensive. That binary mindset doesn't survive 2026. You must be defensive and opportunistic at the same time. Stability protects. Income sustains. Growth waits for its moment. When volatility creates opportunity, you already have dry powder. When markets rise, you already have exposure. This is how serious portfolios stay flexible without guessing. By the time headlines say it's safe again, positioning opportunities are gone. In the next part, I'll bring everything together into a clear, actionable 2026 investment plan and explain how to adapt it based on age, risk tolerance, and retirement timeline. Because the best strategy is the one you can actually stick to. Structure, assets, timing. Now, let's assemble the full 2026 plan without complexity or guesswork.
If you remember only one thing about investing in 2026, remember this. The goal is not to win headlines. The goal is to still be standing and compounding when others aren't. Now let's put everything together into a clear, usable 2026 investment plan. No complexity, no predictions, just structure that adapts. This plan works because it accepts a reality many investors resist. Uncertainty is permanent. So instead of fighting it, we design around it. The foundation of the 2026 plan is layered allocation, adjusted by age and timeline. If you were within 10 years of retirement, capital preservation and income stability dominate. That typically means a larger stability capital layer to prevent forced selling, income-focused assets that grow payouts over time, controlled, smaller growth exposure for inflation protection. At this stage, the biggest risk is not missing upside, it's sequence of returns risk. A bad early drawdown can permanently damage retirement income.
And that damage cannot be reversed with optimism. If you are 10 to 20 years from retirement, balance becomes critical. You still need stability, but growth must be present. This stage benefits from a meaningful income layer to reinvest cash flow, growth exposure sized for volatility tolerance, and automatic rebalancing to control emotional drift. This is where compounding quietly accelerates if discipline holds. If you are younger or still accumulating, flexibility matters more than defense. But that doesn't mean recklessness. It means strong growth exposure with asymmetric sizing, stability capital to avoid panic exits, and learning to rebalance instead of react. Even aggressive portfolios fail when investors abandon them mid-cycle.
The best strategy is useless if you can't stick to it. Across all ages, 3 execution rules matter more than asset selection. Rule 1. Rebalance on rules, not feelings. Set thresholds, follow them. Rule 2. Increase contributions when pessimism rises. That's how long-term math works. Rule 3. Reduce exposure when concentration increases, not when fear does. This is how smart money compounds without stress. Now, let's address a hard truth. Your biggest enemy in 2026 is not inflation, not interest rates, not even market volatility. It's inconsistency. Changing strategies mid-cycle, chasing narratives, abandoning structure. These behaviors destroy returns far more effectively than any downturn. The investors who succeed in 2026 won't look brilliant in the moment. They'll look boring, measured, unemotional. But 5 years later,
their results will quietly separate them from the crowd. That's how wealth has always been built in uncertain decades, not by prediction, but by preparation. If you adopt this plan, adjust it honestly to your life stage, and execute it with discipline, you don't need to fear 2026. You'll be positioned for it.
The market doesn't reward confidence. It rewards structure. And now you have one. If you like these videos, please subscribe my channel and share it. If you want to know something, please comment.